In 2019, a company that rented desks was worth more than Ford, Marriott, and Macy's combined. That company had never made a profit. Not once. Yet WeWork convinced the world it was worth $47 billion, burning $219,000 every single hour to keep the illusion alive. Within months, it would lose everything. And it all began with one man's story. Adam Neumann was born in 1979, raised on a kibbutz outside Tel Aviv, where daily life revolved around shared labor and communal meals. The language of unity and belonging was not a marketing tool, it was the air he breathed. Years later, Neumann would say, "We built a community, the same way my parents built theirs on the kibbutz." That sense of collective purpose became the bedrock of his pitch, but the road to WeWork was paved with small failures and restless ambition. After moving to New York, Neumann cycled through a series of inventions: a pair of collapsible high heels, then baby pants with built-in knee pads. Patent filings and product brochures show these ventures never gained traction. Investors passed, shelves stayed empty, but each attempt sharpened his sense for what people wanted to hear: a promise of transformation, not just a product. In 2008, Neumann co-founded GreenDesk, a sub-leasing business in Brooklyn that offered eco-friendly co-working before the term was mainstream. The timing was right. Just months after launching, he and his partner sold GreenDesk for roughly $3 million, as documented in the New York State sale agreement. The payout was modest by future standards, but it gave Neumann something he had never had before: seed capital, a track record, and the confidence to think bigger. The next idea would not just fill empty offices, it would sell the dream of belonging on a global scale. Inside the glass-walled offices of WeWork's first Manhattan location, Adam Neumann began to speak in terms that left real estate behind. He called WeWork the world's first physical social network, a place where work and life could finally merge. The company's mission statements grew more ambitious with every funding round. The S1 filing read, "Our mission is to elevate the world's consciousness," echoing Neumann's own words on stage and in interviews. This was not just a company, he insisted, but a movement, a global community that would redefine what it meant to belong. Media outlets took notice. Time magazine, in a glowing 2018 profile, described WeWork as a force changing the way people work, live, and connect. The headlines focused less on square footage and more on the promise of transformation. Investors and journalists repeated the language of purpose and disruption, blurring the line between business and belief. Neumann's pitch became legend inside the company. A former executive described him as probably the best salesman of all time. He spoke of becoming the world's first trillionaire, of living forever, of a company with no limits. Employees memorized phrases like "do what you love and create your life's work." The brand itself became the product, a story that could be sold to anyone with a checkbook and a dream. This narrative magnetized billions in capital, setting the stage for a flood of SoftBank money and a valuation that soared to $47 billion. But beneath the slogans and the press, the business itself remained a network of rented desks and long-term leases. The story was now global, and the world was buying in. In June 2017, Adam Neumann sat across from Masayoshi Son, the billionaire founder of SoftBank. The meeting lasted barely 12 minutes. By the end, Son had promised $4.4 billion in investment, one of the largest checks ever written to a private startup. Neumann's vision, not his spreadsheets, convinced Son. He wanted to build more than a company. He wanted to reshape how people lived and worked. Son, famous for his own appetite for risk, saw in Neumann a founder who matched his ambition. The money arrived quickly, and with it a mandate for hypergrowth. SoftBank's Vision Fund did not just provide capital, it demanded scale. WeWork exploded from a handful of United States locations to more than 700 sites in over 100 cities worldwide by 2019. The company entered markets from Sao Paulo to Shanghai, opening new spaces at a pace that dwarfed rivals. Each new office became another data point in a story of unstoppable momentum. Expansion numbers filled investor presentations, 400,000 members, dozens of countries, a headcount that doubled year over year. Revenue soared, but so did losses. In 2018, WeWork posted $1.8 billion in revenue and $1.6 billion in losses. Yet the money kept coming. By January 2019, SoftBank's fresh rounds pushed WeWork's valuation to a headline $47 billion. The logic was simple: growth at all costs, fueled by capital that seemed limitless. Traditional real estate metrics like lease obligations and cash flow were downplayed or ignored. Instead, the company's value became a function of its narrative and the size of its war chest. As long as the Vision Fund kept writing checks, the story held together. But the speed of expansion and the size of the bets meant that any misstep would be felt on a global scale. Inside WeWork's finance department, spreadsheets told a story that never made the S1 cover. The company signed leases for 10 to 15 years, locking in billions in fixed rent, yet most members paid month to month and could leave at any time. In 2018, WeWork took in $1.8 billion in revenue, but lost $1.6 billion, burning through cash at a rate of $219,000 every hour. Lease obligations alone totaled $2.7 billion, and more than 80% of costs were tied up in rent and operations, expenses that did not disappear when a floor sat empty. Analysts flagged the mismatch. The only way to cover the gap was relentless growth, but every new location meant more long-term risk. Internal profit and loss statements showed that even at high occupancy, many sites never broke even. The math was unforgiving. To avoid a cash deficit, occupancy needed to reach levels that were rarely sustained outside flagship buildings. Governance documents offered no safety net. Adam Neumann controlled the board with a 20-to-1 supervoting share, giving him final authority over every major decision. He approved a $5.9 million payment from WeWork to his own holding company for the rights to the word we. Before the IPO, he extracted nearly $700 million in personal liquidity, while the company's losses mounted. To the finance team, these weren't quirks, they were warnings. But with the founder holding 20 times the votes of any investor, dissent was powerless. The architecture of WeWork's growth was designed for speed, not survival. Once public scrutiny arrived, every weakness would be exposed. The S1 filing landed in August 2019, filled with mission statements about elevating consciousness and transforming community. But beneath the language, analysts and journalists found a different reality. The numbers revealed $1.8 billion in annual revenue and $1.6 billion in losses. Lease obligations stretched into the tens of billions, while membership contracts could be cancelled with 30 days' notice. The Wall Street Journal called it a prospectus for a movement, but investors saw a company burning through $219,000 every hour. Within days, headlines turned from praise to skepticism. The S1 filing's fine print exposed Adam Neumann's $700 million cash out, the $5.9 million trademark deal for the word we, and a board structure that left him with 20 times the voting power of any other shareholder. Corporate governance experts called it a case study in unchecked founder power. The valuation, once $47 billion, began to slide. SoftBank, which had fueled the ascent, now faced the prospect of a write-down measured in billions. By September 2019, the IPO was pulled. Neumann resigned under pressure, walking away with an exit package worth up to $1.7 billion. SoftBank took an 80% stake in the company and began slashing costs. Nearly 2,400 employees lost their jobs. The era of charismatic control ended in a matter of weeks, replaced by emergency management and a new mandate: survival at any price. March 2020 brought an abrupt reckoning. As offices emptied around the world, WeWork's global occupancy crashed from 71% in February to just 31% by the end of March. The company lost over $1 billion in monthly rental revenue almost overnight. With long-term lease obligations still in force, the business model that once promised resilience now revealed its true fragility. By 2021, WeWork attempted a comeback through a merger with a special purpose acquisition company, or SPAC, valuing the business at $9 billion, less than a fifth of its peak. Shares began trading under the ticker WE, but the optimism faded fast. By November 2023, the stock had fallen below 10 cents, and WeWork filed for Chapter 11 bankruptcy with $18.65 billion in debt and just $45 million in equity left on the books. The numbers made clear that nearly all of the original $47 billion in value had vanished, leaving behind only obligations and empty offices. Even as the company unraveled, Adam Neumann resurfaced. In early 2024, he offered $500 million to buy back WeWork out of bankruptcy. Creditors rejected the proposal, citing the vast gulf between the offer and the $18 billion owed. Neumann, undeterred, turned to a new venture called Flow, raising $350 million from investors for another attempt at reinventing communal living and work. The promise of belonging still drew capital, but now the story would be tested by a market wary of vision without discipline. Today, hype still outpaces substance across Silicon Valley. WeWork proved a story can sell billions until the numbers demand answers. When the founder is the product, removing him erases the illusion. In business, vision without discipline collapses. The next unicorn will face the same test. What endures is reality.